Every single morning, um, millions of people just open their laptops, look at a glowing chart, and confidently click buy.
Right, yeah.
And, by the end of the year, 95% of them will have just completely lost their money.
It's brutal.
It really is. So welcome to this deep dive. If you're listening to this, you have probably felt that magnetic pull of financial freedom. I mean, we all have, right?
Oh, absolutely. Everyone wants that.
Yeah. That intoxicating idea of being your own boss, opening a laptop on a beach somewhere, and just pulling an income out of the thin air of the financial markets.
The dream.
Exactly, the dream. But today, we're stripping away all those Instagram filters to look at the brutal, unvarnished statistical reality of those markets.
And we have an incredibly dense stack of sources to unpack today for you. We're looking at a massive collection of metadata, video descriptions, and just raw insights from the absolute top echelons of trading education.
Right, the actual heavy hitters.
Exactly. This includes data from verified multimillionaire traders, people like Lance Brightstein.
Who is a legend, by the way.
Yeah, he holds the record for the highest profit and loss at the proprietary firm Trillium. And we also have material from Ross Cameron of Warrior Trading.
Okay, so a lot of high-level perspective.
Right. But to balance that out, we're also looking at overarching, sobering industry statistics from platforms like Tradeociety, The Street, ACY, and Funding Traders.
And our mission today is really to answer one critical, kind of agonizing question. Why do 95% of retail traders fail? And what are the exact step-by-step mechanical and psychological systems that the other 5% use to survive and actually thrive?
Yeah, it's not just about giving you a list of tips.
Right. Instead of just giving you a list, we're going to walk through the actual life cycle of a doomed trader. We'll explore the exact failure scenarios, the neurobiology of financial loss, which is fascinating, and the corrective frameworks you actually need.
It's a lot to cover.
It is. Okay, let's unpack this. Let's start with the elephant in the room, the failure rate itself.
It is a staggering number, really, and it sets the foundation for our entire analysis today. When you aggregate the industry data, whether it's an article from the CISDREET or internal reports from ACY or, commentary from someone like Lance Brightstein, they uniformly cite the exact same grim statistic.
The 95%.
Right. 95% of retail traders fail. And actually, some of our sources even push that number to 99% when you narrow the timeline to long-term, multi-year consistency.
Wow, 99%. I mean, think about that. If you have a 95% chance of your car exploding when you turn the key, you would take the bus.
You wouldn't even go near the car.
Exactly. Yet people flock to day trading every single day. And here's where it gets really interesting, I think. There's this massive glaring contradiction in the trading ecosystem.
Oh, the marketing versus the reality?
Yes. The empirical data says you're almost guaranteed to lose. But the marketing, the algorithms feed you a totally different reality.
It creates this lethal cocktail of cognitive dissonance. I mean, you look at the titles in our source metadata, and it is just a constant barrage of hyperbole.
Give me an example, because it's wild.
Okay, well, you have titles screaming things like, meet the 24-year-old who makes $750,000 per week.
Oh, my God.
Or verified trader took $6,000 to $25 million breaking the #1 trading rule.
Right. It's like a casino aggressively advertising the one single guy who hit the mega jackpot, plastering his face on every billboard across the highway while quietly hiding the thousands of people who just lost their life savings and had to take out a second mortgage.
That's a perfect analogy.
So the expectation for you, the listener, is fundamentally skewed from the very first click on YouTube.
And what's fascinating here is how that initial expectation doesn't just mislead you intellectually, it literally alters your neurobiology before you even place a single trade.
Wait, really? How so?
Well, we know from behavioral finance that the anticipation of a massive reward actually spikes dopamine levels higher than the actual reward itself.
Oh, wow. So just thinking about the Lambo gets you high.
Exactly. So these beginners enter this extremely complex, highly capitalized arena, totally primed by dopamine, expecting what one of our sources from SMB Capital explicitly calls easy money trades.
Easy money in the hardest market in the world.
Right. They are biologically wired by the marketing to believe that profitability is just a matter of knowing a secret trick. But then, you look at the fine print.
The reality check.
Yeah. Take Ross Cameron from Warrior Trading. In the description of his videos, he doesn't lead with the glitz. He leads with a blunt disclaimer.
What does it say?
It states that day trading is risky, most traders lose money, and you should never trade with money you can't afford to lose.
Okay, but let me push back on that for a second, though. Is a disclaimer like that actually helpful? Or is it just a guru covering his legal bases?
Well, it's a bit of both, honestly.
Because on one hand, he's saying most people lose, but the title of his video is literally How I Made $1 Million in 51 Days of Day Trading.
Yeah, the juxtaposition is crazy.
Right. If I'm a novice, I'm ignoring the disclaimer. I'm thinking, well, the 95% who lose are just idiots. I'm going to be the guy who makes the million.
And you've hit on the exact psychological trap right there. The disclaimer might be for legal protection, sure, but the contradiction highlights the core issue. The novice believes they are the exception without having to do any of the foundational work.
Just skip right to the end.
Yeah, when a retail trader comes in expecting to make $750,000 a week, they don't behave rationally. They don't respect the learning curve at all.
No, why would you? You're going to be rich by Friday.
Exactly. And because of that impatience, which is born from entirely unrealistic expectations, they inevitably make aggressive, structurally flawed decisions.
I mean, if you think about any new skill you've ever tried to learn, expecting instant mastery is a guaranteed path to failure.
Every single time.
Like, if you decide you want to take up golf and you genuinely expect to shoot a 72 with the Masters next week, you aren't going to spend time working on your grip or your stance.
No, you're just going to swing the club as hard as humanly possible, probably pull a muscle, and then quit.
Right. Trading is exactly the same, except instead of a pulled hamstring, you decimate your bank account.
That analogy perfectly illustrates the lack of process. The financial markets are an environment where you are competing against the sharpest quantitative minds, the fastest algorithmic computers, and the most well-capitalized institutions on the planet.
And you're sitting in your pajamas on a laptop.
Exactly. Believing you can extract money from them because you watched a 20-minute YouTube video is the first fatal error.
So the marketing hype and the dopamine spike kind of light the fuse. But let's get into the actual mechanics of the explosion.
The fun part.
Right. How does a trader actually go from a hopeful beginner to losing everything? Let's walk through the life cycle of a doomed trader. According to our data, what is the first major failure scenario?
Okay, so the first phase of failure is what the sources identify as the strategy hopper.
The strategy hop. Okay, explain that.
A channel called the moving average specifically calls out this behavior because the trader expects immediate outsized returns. The very moment a strategy results in a loss, they abandon it.
Just drop it immediately.
Yeah, they view a single loss as empirical proof that the strategy is broken rather than just, a normal statistical variance.
You see this perfectly reflected in the search trends in our metadata, too. People are desperately searching for magic bullets.
Oh, constantly.
They're typing in things like, the one candle scalping strategy I will use for life, or the Bollinger Band edge most traders never discover.
The secret codes.
Right. I mean, they tweet these indicators like they are cheat codes in a video game.
Yeah.
Well, let's actually unpack one of these.
Let's do it.
Take Bollinger Bands, since they get brought up so often. People throw that term around to sound smart, but what is it actually doing mechanically?
Well, a Bollinger Band isn't magic. It is simply a visual representation of standard deviation.
Okay, math class, break that down for us.
So it calculates the moving average of an asset's price. Let's say we're looking at Bitcoin over a set period. And then it draws upper and lower bands that represent two standard deviations away from that average.
So it's basically tracking how crazy the price action is getting compared to normal.
Mechanically, yeah. It tells you how far the price has stretched from its historical norm. Think of it like a rubber band.
A rubber band.
If Bitcoin shoots up and hits the upper Bollinger Band, the rubber band is stretched incredibly tight. Mathematically, it is highly probable that the price will eventually snap back toward the moving average.
Okay, so the professional trader sees the rubber band stretched tight on the Bitcoin chart, and they use that mathematical context to frame their trade.
Right, they use it as a tool.
They know that over 100 trades, shorting that overextension gives them a probabilistic edge. Not a guarantee, but an edge.
Precisely. But the strategy hopper doesn't understand standard deviation.
They don't care about the math.
They just watch a video that says, sell when it hits the top line. So they
Well.
try it on Bitcoin.
And what happens?
Well, maybe there's a massive macroeconomic news event that day, and Bitcoin just keeps tearing higher, completely ignoring the band. The rubber band essentially snaps.
Because it's a crazy market.
Right, so the amateur loses money on 2 trades and immediately decides Bollinger Bands are a scam.
They delete the indicator entirely.
Yeah, and the next day they are searching YouTube for a new magic bullet. They never stay with one system long enough to understand its nuances, its drawdowns, or, its ideal market conditions.
They are essentially running on a treadmill, switching out their shoes every 3 minutes, hoping the new shoes will do the running for them, while completely ignoring their own lack of cardio.
That is exactly what it is. And because they refuse to build their own cardio, their own market intuition, they naturally progress to the second failure scenario in the life cycle.
Which is?
They get exhausted trying to find the perfect strategy, so they decide to just copy someone else. They become a mirror trader.
Ah, the mirror trader, which Ross Cameron is absolutely fierce about in his warnings.
He really is.
He explicitly states, "Do not mirror trade me or anyone else. Mirror trading is extremely risky."
Very clear warning.
But let's play devil's advocate here for a second.
Okay.
If Lance Brystein has over $100 million in verified profits from his time at Trillium, why wouldn't I want to just pay a monthly fee, sit in a Discord room, and copy every single button he clicks?
It's a fair question.
Right. If he's a genius, shouldn't I just piggyback on his genius?
On the surface, it sounds logical, but mechanically and psychologically, it is devastating. First of all, there is the mechanical execution lag.
Execution lag, meaning the time it takes to place the trade.
Exactly. By the time a professional identifies a setup, enters the trade themselves, types the alert into a chat room, and then you read it and execute it, the price of that asset has already moved.
Oh, wow. Yeah, because they're trading fast.
In day trading, seconds matter. You are inherently getting a vastly worse entry price than the professional. But honestly, the psychological damage is far worse.
Because you're outsourcing your conviction.
Exactly. When you mirror trade, you completely bypass the neural pathways required to build resilience. You don't understand the why behind the trade.
Give me an example of how that plays out.
Let's go back to our Bitcoin example. Let's say the guru buys Bitcoin at $60,000. You copy them.
Okay, I'm in at 60.
But then the price drops to $59,000. Because you don't know the strategy, you start to panic.
Right, because I'm down money and I don't know what's happening.
You don't know if the guru is planning to cut the loss immediately or if they are systematically scaling into a larger position because they identified a massive support level at 58,000. You are flying completely blind.
So when the trade inevitably goes against you, you just blame the guru.
Always.
You say, well, their alert was bad. And you never have to take accountability for your own financial decisions.
And without accountability, you cannot improve. You are basically treating the market like a roulette wheel where the guru is the one spinning the ball.
Just gambling.
Yep. This outsourcing of responsibility inevitably leads to the final, fatal stage of the amateur's life cycle, the over-leverager. This is where the account finally blows up.
The sources talk about this in deeply painful terms. You see titles like 7 Painful Lessons I Learned from Blowing Up 7 Trading Accounts, or Trader Drysdale's video, I blew 3 accounts before I learned this.
Yeah, it's a very common trauma.
Let's get really granular here, though.
Yeah.
What does blowing an account actually entail? Because we aren't just talking about a bad day at the office, right?
No. Blowing an account means you have lost all or virtually all of your tradable capital.
Just gone.
Gone. You have hit zero or dropped so low you can no longer even meet the margin requirements to open a position.
So you're literally locked out of the game.
Exactly. Mechanically, this happens because of a complete lack of risk management. Because the trader is desperate for that dopamine hit of making huge money, they put way too much of their account size into a single trade.
They go all in.
Often using borrowed money leverage from their broker to amplify their position, and they ignore their stop losses.
The stop loss being the automated safety net you put in the system to sell your position if it drops to a certain price.
Right.
It's supposed to save you from yourself.
Yes, exactly. But the amateur manually cancels it when the price gets close because they refuse to accept the reality of the loss.
I really want to focus on the neurobiology of this moment because it explains so much of why we fail.
It's the most important part.
I can visualize the scenario perfectly. You buy gold, hoping for a breakout.
Okay, gold.
Instantly, the candlestick turns red and starts dropping. Instead of taking a small, pre-planned paper-cut loss of $50, loss aversion bias kicks in.
The panic.
Yes. The human brain literally processes financial loss using the exact same neural pathways that process physical pain.
That is a crucial insight. It is not a metaphor. It is a physiological reality.
Right. So your brain feels like your hand is on a hot stove. But instead of pulling away, Your logic centers just shut down.
The amygdala takes over.
Yes. Your heart is hammering. You start sweating. The loss goes from $50 to $500 to $1,000.
And you just freeze.
You tell yourself, it has to bounce back. It's gold. It can't just keep dropping. You become totally paralyzed, like a deer caught in the headlights, until the broker steps in, forcefully liquidates your position to protect their own borrowed money, and your account is just gone.
It's devastating. And if we connect this to the bigger picture, the aftermath of blowing an account is profound. It's a total destruction of self-confidence.
I can imagine.
The trader just sits there staring at a zero balance, feeling entirely out of control, and inevitably concludes, I'm just not smart enough for this.
But as the moving average highlights in a specific chapter of their breakdown, you are not broken.
Yes, that might be the most important phrase in this entire deep dive. You are not broken.
It's such a relief to hear, honestly.
It is vital. The failure is not a personality defect. You aren't inherently bad at logic. It is a process defect.
Process defect, I like that.
You were trying to build a skyscraper without pouring a foundation, getting furious when the wind blew it over, and deciding you were just a bad architect.
So if you aren't broken, and it's just a flawed process, then there is a mechanical fix.
Exactly.
The sources transition very clearly from identifying this chaotic life cycle to outlining the incredibly rigid, disciplined frameworks used by the 5% who actually survive.
The survival guide.
Let's break down these corrective systems. Step 1, which Ross Cameron insists is non-negotiable, the simulator.
Yes. He is adamant that traders must prove profitability in a simulator using live market data but fake paper money before ever trading with real capital.
Which people hate doing.
Oh, the overwhelming majority of retail traders despise the simulator. They want the real action.
Let me play the skeptic again, because I've heard this debate a lot. I'll argue that the simulator is actually useless or even harmful precisely because of what we just talked about, the amygdala.
Interesting. Okay, how so?
Well, if the whole game of trading is emotional regulation and managing cortisol when real money's on the line, how does trading fake monopoly money teach you anything?
I see where you're going.
If my brain knows it's fake, I'm not practicing the actual skill of emotional control. So why bother?
It's a very common pushback, but it fundamentally misunderstands the purpose of the simulator. You are absolutely right that it does not replicate the emotional weight of real financial risk.
Right.
But the simulator is not an emotional training ground. It is a mechanical laboratory.
Ah, okay. Elaborate on that. Mechanical laboratory.
Where you can regulate your emotions during a trade, you have to be able to execute the trade flawlessly without thinking.
Just the physical act of it.
Yes. The simulator is where you learn how your charting software works. It's where you build muscle memory for your hotkeys.
So you don't click buy when you mean sell.
Exactly. It's where you learn the sheer velocity of how fast a market like the NASDAQ can move when macroeconomic data drops.
Just feeling the rhythm of the market.
Right. If you are fumbling with your mouse trying to find the sell button, or if you don't even have a mathematical edge that produces a profit in a perfectly sterile, emotionless environment, it is absolute insanity to think you will be profitable when the pressure of real financial loss is crushing your chest.
Oh, that makes total sense. It's like a pilot in a flight simulator.
Perfect comparison.
You don't put a novice in a real Boeing 747 during a thunderstorm just so they can feel the pressure.
That would be a disaster.
You make them fly the simulator 1,000 times so that when the real engine fails, their hands know exactly which levers to pull instinctively, overriding their panic.
Exactly. You eliminate the mechanical errors first. And once you prove you have that mechanical fluency and a statistical edge, you move to step 2, which is beautifully captured by Trader Drysdale's core lesson.
Which is?
Trading smaller saved me.
Trading smaller, meaning capital preservation over capital appreciation.
Yes. When you make that terrifying transition from paper money to real money, the psychological weight finally kicks in.
The hot stove becomes real.
Exactly. So by trading a tiny size, let's say risking just $10 a trade on a micro contract, you are keeping the emotional volume turned down low enough that your prefrontal cortex can still operate.
You're not triggering the amygdala because $10 doesn't feel like a threat to your survival.
Right. The goal in your first year of trading is not to buy a Lamborghini. The goal is simply to survive the learning curve without blowing up your account.
Which naturally leads to step 3, having an actual empirical roadmap.
The data.
right? The moving average outlines a guided system that heavily emphasizes backtesting and proof. I think backtesting is one of those concepts that really separates the gamblers from the actual professionals.
Oh, without a doubt. Backtesting is the closest thing to a crystal ball a trader has, and yet the 95% almost never do it because it is tedious.
It's boring.
It is incredibly boring. It involves manually scrolling back through months or years of historical chart data and logging every single time your specific setup appeared.
So just staring at old charts for hours.
Yes, and answering questions like, how many times did it work? How many times did it fail? What was the average drawdown before it worked?
It reminds me of card counting and blackjack.
Oh, that's a good one. How so?
Well, backtesting is like counting cards. It doesn't guarantee you won't bust on the very next hand you play.
True.
You could have a perfect setup and still lose that one specific hand. But it guarantees that over 10,000 hands, the mathematics tilt in your favor and the casino pays you.
That is a brilliant mechanical metaphor, and it actually brings up a highly counterintuitive truth about profitability that most novices don't grasp.
What's that?
Your win rate versus your risk-to-reward ratio.
Okay, break that down.
Amateurs are obsessed with having a 90% win rate. They want to be right all the time because their ego demands it.
Right. Nobody likes losing.
But if you look at the best trend-following traders in the world, their win rate is often shockingly low, sometimes hovering around 40%.
Wait, really? The top traders are literally losing more than half the time.
Yes, because they have a deeply skewed risk-to-reward ratio.
How does that work in practice?
Well, when they lose, their strict risk management cuts the loss at, say, $100. But when they catch a trend, they write it for $1,000.
Oh, I see the math here.
Right. If you lose 6 trades at $100 each, you are down $600. But if your next 4 trades make $1,000 each, you are up $4,000.
Wow.
So you have a 40% win rate, but you are massively profitable. Backtesting provides the mathematical proof that allows a trader to endure those 6 consecutive losses without strategy hopping.
Because they have the data. They know the win is coming if they just stick to the system.
Exactly.
And that data is crucial for step 4, which is how you handle the inevitable losing streaks. Lance Breitstein covers this extensively in his frameworks for handling trading drawdowns.
Yes, and a drawdown is just the peak-to-trough decline of your account balance. Every trader on Earth experiences them.
Even the pros.
Even the pros. The difference is the amateur revenge trades.
Oh, revenge trading. That sounds dangerous.
It's the worst. They take a massive loss, get furious at the market, and immediately double their position size on a random trade to try and make it all back in one desperate swing.
Just swinging for the fences.
And that is how accounts blow up. The professional, however, has a pre-written protocol for losing. Breitstein, coming from a highly structured prop firm environment like Trillium, operates on rigid rules.
What kind of rules?
When you hit a drawdown, you cut your position size in half. You review your journal. You walk away from the screens. You do not negotiate with your own rules.
I have to be completely honest with you, though.
Okay, let's hear it.
I'm listening to these 4 steps, spending months in a fake simulator, risking $10 a trade, manually building spreadsheets of historical data, and having protocols for when you lose. And it sounds incredibly tedious.
It is.
It's the absolute antithesis of the meet the 24-year-old, making $750K a week marketing.
Totally different worlds.
It's like someone coming to you, begging for the secret to a great physique, hoping for a biohack or a magic pill. And you tell them the secret is eating plain chicken breasts and doing squats every day for 4 years.
Yeah, no one wants to hear that.
Nobody. They want the shortcut.
They don't want to hear it, but consider the source of the advice. Look at Lance Breitstein's credentials. This is a man who spent over a decade trading equities at a highly competitive proprietary firm.
He's not just a YouTuber.
No, he mentors 7- and 8-figure traders. He has over $100 million in verified profits. And what kind of content does he produce? He doesn't sell a magic indicator.
Right.
He has a 20-minute video entirely dedicated to 15 years of trading risk management. When a trader at the absolute pinnacle of the industry tells you the secret is managing your risk, you must listen.
It's the boring stuff that actually works.
Exactly. The core truth of the industry is this. Amateurs focus entirely on how much money they can make on a trade. Professionals focus entirely on how much money they can lose.
Amateurs focus on the reward. Professionals focus on the risk. That really flips the entire script.
It changes everything.
But okay, let's unpack this. Let's say I actually do the boring work.
Okay, you eat your chicken breast.
Right. I eat the chicken. Let's say I backtest my strategy, I build my spreadsheet, I have my card counting edge, I use the simulator, and I have strict rules about risking only 1% of my account.
You have the perfect mechanical system.
Exactly. Why is it that in the heat of the moment, with real money on the line, people still break their own rules?
It happens all the time.
They know they shouldn't move their stop loss, but they do it anyway. It seems like the final boss of trading isn't the market at all. It's the mirror.
You've hit on the absolute core of the issue right there. The final boss is entirely psychological.
The mental game.
Yes. The metadata in our sources overwhelmingly points to this mental game as the ultimate differentiator. We see titles like Humbled Trader's Verified 8-Figure Trader Explains Statistics and Trader Psychology, or How I Beat the Mental Game of Trading.
So it's heavily discussed by the Tros.
Oh, constantly. And the foundational text for all of this, referenced heavily throughout the sources, comes from trading psychologist Mark Douglas.
Right. The sources reference his concepts with videos titled Before Profit Comes Pain, the 3 stages Mark Douglas warned about.
Yes.
So what is his core philosophy? What's the secret?
Douglas's central premise is that the financial market is a completely unstructured environment.
Unstructured. Okay. How does that differ from normal life?
Think about your normal life, your career, your schooling. If you study hard, you get an A. If you follow the rules at work, you get promoted.
Right. Cause and effect.
Exactly. There is a structured relationship between doing the right thing and getting a positive outcome. But the market does not care about you.
It's completely indifferent.
Yes. The market can reward you for a terrible, reckless, over-leveraged trade, and it can punish you for a perfectly executed, risk-managed trade.
That is terrifying.
It is.
Because if you do everything wrong, gamble your whole account on a whim, and happen to win big, the market just reinforced a terrible habit.
Exactly. It wires your brain to believe that recklessness equals reward. Douglas teaches that to survive in an environment with zero external rules and zero reliable correlation between a single action and its immediate outcome, you must create incredibly rigid internal rules.
So the structure has to come from inside you because the market won't give it to you.
Yes. And more importantly, you must have the psychological discipline to follow those internal rules without hesitation, regardless of the outcome of the previous trade.
This raises an important question, though, about all the technical stuff we see.
The charts.
Yeah, the charts, the candlestick patterns, the Bollinger Bands. I've heard skeptics call technical analysis astrology for men.
That's a popular joke, yeah.
If the market is a random, unstructured environment where anything can happen on any given trade, why are we spending hours back-testing chart patterns? Isn't that a massive contradiction? Are technical indicators actually useless?
It's not a contradiction if you understand the difference between micro-randomness and macro-probability.
Okay, those are big words. Break that down.
Technical tools are not crystal balls. They do not predict the future of one specific trade. They are simply tools to aggregate past data and present it visually to frame context.
To see the bigger picture.
Right. They help you identify areas where human psychology, which repeats itself constantly, might skew the probability slightly in your favor. But you are absolutely right in the sense that a technical edge is completely useless without emotional regulation.
Because humans are fundamentally emotional creatures,
Yeah.
and the charts are really just visual representations of fear and greed.
Exactly. Let's look at fear of missing out, or FOMO.
Oh, FOMO's huge.
You'll see Bitcoin printing massive green candles on the chart, rocketing up thousands of dollars in minutes. Your technical plan, backed by your data, clearly says, do not buy here, it is overextended, wait for a pullback. But your lizard brain takes over. You think everyone on the internet is getting rich right now except me.
Greed overrides the plan.
Yes. Greed and FOMO override your technical plan. You buy at the absolute top, and the moment you click buy, the market reverses.
And then the other side of the emotional spectrum kicks in, right? The fear of loss.
Immediately.
The trade reverses, and you are instantly underwater. Your technical plan clearly dictates where the trade is invalidated and where you must cut the loss. But your ego cannot handle being wrong.
The pain is too much.
The physiological pain of accepting that loss is just too great. So you ignore the chart entirely, you cancel your stop loss, and you hold on to a sinking ship hoping for a miracle.
And that's how it all falls apart. So the technicals tell you what to do, but your neurobiology determines whether or not you actually do it.
Wow.
There is a fascinating video in the sources from a channel called Stick Trader titled The Japanese Method to Eliminate All Bad Trading Habits.
What's the method?
It points exactly to this need for a consistent mindset. It's about building a framework to regulate your emotions, systematically eliminating those impulsive reactions.
It's about self-mastery.
That is the ultimate defining edge. The 5% who succeed, the people making millions, they do not possess a secret, magical chart indicator that the 95% lack.
They aren't using a different Bollinger Band.
No. They are often looking at the exact same moving averages and support levels as the amateur. The difference is their vastly superior emotional regulation.
They've tamed the lizard brain.
They have trained their minds to view a loss not as a personal failure or a threat to their ego, but as a mere business expense.
Just a cost of doing business.
Yes. A simple data point in their larger probabilistic model, they execute their edge flawlessly over hundreds of iterations, completely detached from the emotional outcome of any single trade.
They've mastered themselves so they can navigate the market. That is incredibly powerful.
It really is.
Let's pull all of this together and synthesize the journey we've taken today. We started with a mission to understand why 95% of retail traders fail and what the 5% do differently.
And the data is very clear.
It paints a very clear picture. The 95% do not fail because the market is rigged in some grand conspiracy against them, or because they haven't found the secret candlestick pattern.
No. They fail because they succumb to the cognitive dissonance created by unrealistic expectations.
The dopamine.
They are impatient. They operate without a blueprint, hopping desperately from strategy to strategy. They outsource their conviction and avoid accountability by mirror trading.
Right.
And most destructively, they allow loss aversion and ego to override risk management, over-leveraging their positions and blowing up their accounts.
And on the flip side, the 5% who actually survive, the Lance Brightsteins of the world, they succeed by embracing the boring, unglamorous work.
The chicken and broccoli.
Exactly. They prove their mechanical fluency in simulators. They trade incredibly small to preserve capital while they learn the rhythms of the market. They rigorously backtest their strategies to build statistical proof, understanding that a 40% win rate can be highly profitable with the right risk-to-reward ratio.
It's a business.
They have step-by-step, non-negotiable protocols for handling drawdowns. And above all, they master the mental game, utilizing deep emotional discipline to execute their plans without letting fear or greed hijack their prefrontal cortex.
It is a profound psychological transformation. You are evolving from a gambler seeking a dopamine thrill into a highly disciplined risk manager operating a statistical business.
And what I find so compelling about this is that you do not need to be a day trader staring at a Bitcoin chart to benefit from this philosophy.
Not at all.
These lessons are completely universal. Think about the concept of trading smaller when you are taking risks in your own life.
Yeah, mitigating risk.
Whether you are starting a new business venture, investing in a new relationship, or trying to learn a complex new skill, you don't have to bet your entire life savings or your entire emotional bandwidth on day one.
You don't have to go all in.
You can test the waters, build your process methodically, and manage your downside risk.
The mindset required to succeed in the most chaotic, unstructured financial environment on Earth is the exact same mindset required to navigate the unpredictability of life itself. Acknowledging that you are not broken but simply lacking a tested process is the most empowering realization you can have.
So, if you are listening to this right now, I want you to think about your own experiences, whether in the pursuit of financial goals or just in your general life ambitions.
Take an honest look.
Which of these mistakes have you made? Were you a strategy hopper, jumping from diet to diet or career path to career path, abandoning them the second you faced a minor setback because you expected instant results?
It's so easy to do.
Have you let the fear of missing out override your logical planning?
Yeah.
And more importantly, what step-by-step boring process did you finally implement to correct it?
The clarity always comes from within the process.
We started this deep dive talking about how fixing a problem usually requires a clear diagnostic X-ray. But the financial markets seem entirely murky. Well, it turns out the X-ray isn't meant to be pointed at the candlestick charts. The X-ray needs to be pointed inward. It's your own psychology, your own loss aversion, and your own discipline.
Absolutely.
I want to leave you with this final provocative thought to mull over. If the ultimate difference between making $100 million like Lance Brightstein and blowing up 7 accounts in a row is simply the sheer unrelenting discipline to endure the boring, tedious work of backtesting and risk management.
The hard stuff.
Yeah. What other impossible goals in your life are actually completely within your reach, just waiting for you to stop searching for a magical shortcut and finally start doing the boring work?